Let's do this. Hey, everybody. My name is Jonah Lupton. Welcome back today. So we got another interview for you. We have Erez Raphael, who is the CEO of Dario Health. And we have Richard Chu, who a lot of you know from Twitter, big healthcare investor, also works at Saga Partners. In full disclosure, so I do own Dario Health, ticker symbol DRIO. I own it in my personal account. I also own it in a social capital fund that I run. Richard, what about you?
Yeah, I own a position in Dario in my personal account as well.
Okay. Do you guys own it at Saga?
No.
Okay, cool. So, Erez, how are you today?
I'm good. Thanks for having me, Jonah.
Absolutely. Thanks for joining. So, I haven't done a write-up on Dario Health, so there's probably a lot of people that follow me, that are subscribers on my newsletter, that aren't very familiar with Dario. So why don't you just kind of talk to us about what Dario does, what your main product is, who you sell it to, the business model, all of that, and then me and Richard can start asking some questions.
Yeah, absolutely. So Dario Health is a digital therapeutics company, and we are part of a very big transformation that is happening in the healthcare industry, where the overall mindset is that in order to scale up the treatment of people with chronic condition, which is around 80% of healthcare spent is from chronic conditions, in order to scale up the treatment, you need to get the user to be engaged with his own treatment. So the old way, where you have the doctor as the broker between the disease to the patient, this is something that will over time disappear, because you have users to be engaged with their own treatment. And we have seen it through Amazon and other places in the world that are trying to get the healthcare to be more consumer-centric. And we feel that we built one of the solutions that is very advanced in getting the user into the centric of his own treatment. We started with diabetes, we expanded into hypertension. Recently, we made an acquisition on the musculoskeletal space. And we believe that eventually, if you want to provide a user-centric solution, you cannot have just an application or just a medical device. You need to provide one integrated, extreme experience to the user. And you need to leverage on the data that you are collecting in order to learn whether users are responding to specific treatment. So if in the old world you have someone with chronic condition visiting the doctor every quarter for 12 minutes, and in between the doctor visits, he will be alone. Now we are saying, take our offering, and with our offering, you're going to get 24/7 support in order to engage you, the patient, with your own treatment. And that's the way to scale up the treatment in a way that eventually we can save money to the healthcare system. In the journey of getting the best user experience, which is something that a lot of companies are trying to make, we feel that because of the DNA of the company that was direct to consumer first, we managed to get to a very, very good solution, as it can be measured by reviews on the App Store, or we have I think almost 16,000 reviews with 4.9 stars. On the Amazon, I think that we are 4.4, the Net Promoter Score 77. So we did a very, very long way from the direct to consumer. And what was exciting in the last year and a half is the fact that we said, okay, the solution is mature enough. Let's take it to the B2B market. Let's sell it not just out of pocket, but also through employer health plans and providers. So this is on high level who we are. I will pause here to see if you have any comments or other questions.
So someone can go to your website and actually order your product off of the website, correct?
Yes, the old and the legacy business is that you can order the device, then we will try to upgrade you to be a member. The future of the business is that it will not be possible anymore, because we believe that eventually we should sell only the SaaS. It means the device together with the disposables, together with the application and the coaching, at the moment, you still can buy only the device, but that's something that will not last forever.
And just talk about the device. Anyone that hasn't been to the website that's not familiar with it, you're talking about the glucose monitoring device, right?
Yeah, that's so we have a few devices. One of them is the glucose monitor. Maybe I'll just turn off my background so I can demo it if it is helpful. Hang on.
And it connects to someone's iPhone or smartphone, right?
Yeah, absolutely. This is one of the things that our users like a lot. So it's pocket sized. Almost 30% of our users are holding more than one. And we designed this product from the mindset that the center of the universe of the users is the smartphone, right? I mean, this is what we are doing everything with. So we didn't want to have the competition created a separate device. We said we want to have the same device. So that's the center of the universe. And in order to get this to be a medical device, we have this. And here, if I'm going to open it, you can see a very small piece of electronic that I can take out. And then I'm going to plug it here. And then from a FDA perspective and regulation standpoint, we have here a medical device cleared by the FDA 510K. Now it's going to tell me to hang on. I'm trying.
Yeah, I can't really see it just because the brightness of the phone, it's not coming through. But okay. Oh, there you go. Yep.
And now you can see the messages that Rick is sending me. So that's that it will tell me to put a test strip. I can take it from here. I'm going to open it. I'm going to take one strip from here. This is our strip, proprietary for Dario. And on the other side of the device, we have a Lancet. I'm going to show you how it works. So I'm going to take this strip and plug it into the smartphone. You can see it here. Okay. Now it will tell me to place a drop of blood.
Yeah, I can't see the screen, but we can see everything else you're doing.
Yeah, let's see if I can. And now, if I'm going to prick my finger and take a very small drop of blood, okay.
Yep.
I don't know why you can't see the screen, and then I will put drop of blood here, which is something that our users are doing like every day. Hang on.
And the phone is giving you a reading within perfect. Gives you a reading within 6 seconds, right?
Yeah. So you see, we are green. Sorry, I'm green. I'm not purple. I'm green. So it means that I'm okay. So given my situation, I had lunch like 4 hours ago. I'm in Israel now, so time zone. I had lunch like 4 or 5 hours ago. I'm post lunch. Smartphone knows that. He knows that I'm back from the office, and now it shows that I'm green. If I'm going to go to my logbook, you can see the other measures from the last few days. So you can see that I have those that are a bit purple that are trending high. If it's going to be too high, it's going to be fully purple. If it's going to be too low, it's going to be fully red, and so on. So there is a whole mindset of gamification on how you are not just giving the user the option to check his blood sugar level, but also to understand, okay, what is next in terms of medication, nutrition, and stuff like that. So we are building a whole know-how about the user daily routine and trying to support him along the day. That's the idea.
Now, how many times do you, or how many times does the average person have to take blood every day or test their own blood?
Yes, so usually those that are type 2 that are not injecting insulin, which is the majority of the population, like 25 million in the US, they don't really need to test multiple times a day. The old days, you have the medical devices companies that made revenue from selling these test strips that I just showed. That's not the business model that we are having. We are having a business model that says, I want to help you, the patient, to have the best outcomes, and I want to help you improve. And it doesn't necessarily says that you need to prick your finger 5 times a day. There are users that are checking their blood sugar 4 times a week, and they're getting to good results, like those that are checking 2 times a day. So the actual checking is not what we are pitching for. We are pitching for a better understanding on how specific actions impact your body, and then we are recommending the users what to do and so on. Usually when we are onboarding users, we are helping them to learn their bodies and they are checking more. But over time, we're not going to send them a message that says, check today, check again, and stuff like that. That's not the mindset. The mindset is very engaging. The mindset is a lot about content, a lot about support, a lot about how we can get this sticky with the user and not necessarily force the habit of testing the blood sugar. That's not the business model, because we are not making money from the test strips. We are making money from getting people healthier. So if we have users that are very engaged and staying over time, and eventually they learn how specific food impact their blood sugar level, how specific medication impact their blood sugar level, and we help them implement all this know-how, over time, we're going to see an improvement in the standard deviation of the blood sugar level, and then we'll help them improve the HbA1c. And that's the overall objective, and not to get them to test more necessarily.
Now, I know on your last earnings call, you announced that you've signed up a couple Fortune 500 companies, correct?
Yes, absolutely.
I assume you can't tell us what companies they are. So maybe you can just talk to us about, what does it take to sign up one of those clients? How long is that sales cycle? How many employees does that give you access to? And I mean, obviously it's opt-in for the employees, right? It's only employees that have type 2 diabetes in this case?
Or hypertension, it depends on the agreement, because we are selling hypertension. Second half of the year, we'll be able also to get into the employers, also the MSK. So usually this sales cycle is like, 12 to 18 months. Usually when you are signing, it's going to go to the next year. So usually like 20% of what we are signing is off cycle, and 80% is that cycle that is launching every beginning of every year. On these specific employers, we were winning over the competition with on an RFI, and we also so this is, I would say, a medium big kind of employers. Usually the population, I mean, like a big employer will have like something like I would say 30,000 employees, 50,000 employees, 100,000 employees. On 100,000 employees, usually we'll have like 8 to 10%, like 10,000 that are diabetic. And eventually, we know from the competition that they are somewhere in the ranges of 32% enrollment rate. We just on the earning, we talked about the fact that we exceed the 30% enrollment rate. Probably we are more toward like numbers that are above 35%. So we are doing very well on the enrollment. Moving forward, we'll have to see also the engagement level, which is something that we are very confident that we have big time, because we have an experience from 70,000 active paying users that are coming from the B2C. So we know exactly how people are, behaving on the platform and so on. The unit economic, just to help, investors make the calculation and understand how much we can extract per every employer. So the unit economic for the first disease is like $60 per member per month. As soon as someone is getting on the platform, we are charging for the next 3 months, and then every month we keep charging. We keep bill the employer for the users. There is no copay. Everything is being paid. And it depends on us how many users we are opting in from the overall population. We are integrating like the HR of the enterprise is sending an email to the employees and offering this kind of solution. We also approach them from our email, and we're also calling them. So there are multiple sub-channels under which we are enrolling and opting in the users. And we have the know-how that is coming from the B2C, because when we were selling B2C, we had people that were looking at us on the feed of the Facebook, and they had to make a decision whether they want to go on the program or not. That's exactly what we are doing when we are getting into the employers. We are not utilizing, in most of the cases, social media, but we do use other kind of digital capabilities in order to enroll users. So So that's more or less the number, $60 per member per month. If we have additional chronic condition like hypertension or comorbidity, we're going to add another $10. So it can get to somewhere like in the ranges of $70. On a 10,000 users, you have a revenue of on average, I would say like around $7-8 million a year run rate.
And who pays that? Is that the employer paying it, or is it the employer's insurance company paying it?
So that's a very good question. Because we are going to the 3 channels, we have the employers, we have the health plans, and we have providers in order to bill Medicare, okay? When we are saying employers, we are referring only to the employer that is paying for that. When we are saying health plans, the health plans will pay for the users on behalf of the employer, like so to say. So both answers are right. At the moment, we haven't shown an agreement with the health plan, but we have shown an agreement with employers. Like out of the 3 channels, we showed the first one, we showed the third one, and we are still pending the, the health plans, which is something that we believe we're going to have in a short period of time, because we invested a lot of time into cracking this kind of channel. This is the most hard channel to crack because health plans are much tougher than employers in terms of adopting this kind of solution. And if you're looking on the competition, they did very well on the employers, and we believe that we'll do also very well on the employers. But we think that on the health plans, investors are not seeing it yet, but we spend tons of time and tons of money in order to crack it. And we believe that we will have advantage on this kind of channel. And that's what we are pushing very hard to get in 2021.
Cool. Richard, I know you probably have some good questions to ask now.
Yeah, for sure. So I think a lot of listeners here were Livongo owners like me, and have really come to know Dario and the whole like digital therapeutics, remote patient monitoring space through that. So I think that previously you mentioned that Dario has been winning some RFPs against Livongo and Omada. And sort of like just from my understanding of why that's been the case, I think that you guys have a couple of competitive advantages. So like firstly, as you mentioned, I think employers are really looking for platforms that can demonstrate not only great ROI, but also good user satisfaction. And so I think like while a lot of the other companies, they really have to actually go out there and get clients and actually demonstrate that, you already have like years of experience in the consumer markets. So like you have a 77 NPS score, you have better blood glucose improvement than Livongo. You have like 14K App Store reviews, 4.9 out of 5 ratings, and you have like almost 70,000 users that are paying out of pocket. So that's one advantage. The second one is that you only bill for engaged members. The Livongo charges per participant instead, so it's more fair in Dario's case. And lastly is because with the open platform, you can allow clients to like integrate with best of class point solutions. So instead of like having Dario do everything, you can have like one sort of solution that can do like MSK, one solution that can do hypertension, and then integrate it all with Dario. So would you say like that's a good sort of summary of, I guess, your competitive advantages?
Yes, absolutely. I want to stay, stick with the terminology, the competition. I don't want to provide the names, but we think that those that went first to the market took advantage on the, setting up the business model in a way that was extremely profitable for them. But we think that the market just started, and I don't think that there is a penetration of more than 2% of the market in terms of getting digitalized. And we think that in order to scale up in this market and go into the health plan, you need to be much more competitive in terms of whatever you provide. So to your point, and I totally agree with you, user experience is number one, that leads to engagement, that eventually leads to clinical outcomes with a very transparent billing process. Only those that are engaged, you get to the platform 3 months, you're paying, and then every month for those that are engaged, we are not, utilizing like other numbers like 3 months or 6 months or 12 months, and I've seen everything out there in the market. Doesn't make sense that someone will pay for a user that was not active for the last 4 or 5 months. And that's something that we are not doing, and that's the transparency that health plans and others want to see. And if you combine everything together, it gets to the bottom line, which is return on investment. If you have a certain population, you want to pay eventually only for those that are active, and you want to get more in terms of the clinical outcomes. And this is the ROI that we are talking about. And this is clearly what we are showing. So it's all about money. We are getting there through user experience, through a very high net promoter score and stuff like that, and also transparent billing process. But the bottom line for the insurer is return on investment, how much I need to pay and what I'm getting. And that's why, we think we're going to be super successful in terms of scaling it up, especially after we got all the funds in order to, because one of the things that the competition had was tons of money. And that's something that you need in order to go into the B2B market. It's not easy to penetrate into this market. And we think that in 2021, like let's say in the last 12 months, we solved, so to say, this problem by raising $100 million that, funding all these kind of activities. So investors should feel comfortable that we're not just having the right solution in place, we also have the right team in place, and we have the right, cash on the balance sheet in order to be successful.
Yeah, and I think like versus, like the telemedicine space, remote patient monitoring, digital therapeutics, there's much higher barriers to entry, which is something that I like about this. So it's not as easily, commoditized. So like with, players like Dario, like Livongo specifically, you can look at, for example, the years of studies that you've done and sort of the proven outcomes that you're still measuring, that you're still demonstrating over time. And that's something that's quite hard for new entrants to do. Also, you have to get your devices FDA approved. So would you say like those are the main barriers to entry that prevent, like anyone just going out there and starting up something like this?
Yes, so I think that the healthcare industry originally, if you're looking on the medical device world, it was like the product development life cycle, or until you generate the first $1 million, you had to have your R&D stage, getting through verification, then it goes into clinical study, you take it to the FDA, and then you get it cleared, and you start to sell. I think that when we are talking, and this is a product development life cycle of like 4 years, 5 years, whatever. I think that in terms of digital therapeutics, and if you're going to go to the Digital Therapeutics Alliance website, you're going to see that they have we have 10 principles. One of the main principles is that you prove your solution with data, you drive your solution with data. So practically, the product development lifecycle, it's not just the R&D, the clinical stage, and the FDA clearance. You have another 2 stages that one is getting tons of users that will generate data, and then you need to take this data and to educate your system in order to be smarter and smarter. And this is something that takes billions of data points and another 3 to 4 years. So the barrier is overall 7 years, tons of money, tons of users that you need on the platform, and then you are going into the B2B market, into the health plans, and showing something that is already working with tens of thousands of users that is already operating. And when we started that 5 years ago, and I talked with people and told them that we're going to go B2C first because we want to have the best solution and we need the data, people told me, this is crazy because it doesn't make sense. The healthcare industry is B2B oriented. And now when I'm talking with other colleagues in the Digital Therapeutics Alliance, I see that every, one out of 2 companies are going B2C first because they understand that without the data, you cannot go to the health plans. It's easy to say, let's sell into the health plans. It's a very long, complicated, and tough sales cycle that is very hard to achieve. And that's something that data and proof is something that is extremely important. So I think that the barrier here is much more than, okay, let's develop a glucose monitor, connect it to the smartphone, and here we have a solution. That's not the case.
Yeah, makes sense.
So,
and yeah,
go ahead.
Jonah, go ahead.
I was just going to ask about the Upright acquisition. So a few months ago, you guys paid $31 million for Upright to get into the muscular skeletal digital space, right? Is that a
Yeah.
good way? What exactly does that company bring?
Yeah, so you know, when we were looking on all the main issues that we are trying to solve, this was at the top 3 issues. And in terms of the philosophy of our company, consumer first, how you can, you know, because our advantage is to help people in between the doctor visits, and we thought that something that can drive behavioral change. This is what we want to do in our company. We knew the company for a while. We knew the R&D team. I knew the CEO. We knew what they built there, and we had a lot of confidence that on our platform we can transform the business model from B2C to B2B in a faster way. And we did all our calculations, and we figured out that it's a no-brainer for us, especially if we can get it at the right price, which is something that we eventually did. So we believe that that's something that is going to have a very positive impact on our financial profile, because if you're looking on the overall commercial capabilities that we have in the States, we're not going to increase the spending there. We're going to have the same spending, and then we're going to just enroll more users that are getting multi-conditions. So from our perspective, from a user standpoint, if you want to provide a user-centric solution and you need to provide something that is personalized, you need to take care of multiple conditions. And from a financial standpoint, scaling up in the B2B market when you have multiple conditions, it's something that is much easier. So we are thinking in a very aggressive way on how we want to grow, not only in 2021, but also into 2022. And that was a very important piece. And if you hear our earnings calls every quarter, we are very, very consistent with the 3 messages. One of them is multi-chronic conditions. So I think that investors should stay tuned, because we didn't finish with the MSK. We're gonna continue at least for another one in 2021 that will help us complete the portfolio in a way that we can extract a lot of dollars per every account that we are signing on.
So are there going to be some good cross-sell opportunities between the customer base from Dario and the customer base from Upright?
At the short term, on the B2C side only, I don't think that it's big numbers. I think that the big numbers will come from the B2B, because if I'm going to an employer and I'm providing now 3 different conditions, and very shortly it's going to be 4, then the upsell into the clients is something that makes a lot of sense. And that's something that is going to save a lot of money and also increase the top line. In a lot of cases, once you are getting into the employer's market, you're also getting access to the family members and so on. And practically the probability that we have that average user will have one of these 3 conditions and very shortly 4 conditions is very high. So that's something that will have a very positive impact on our top line. And one of the things that I reiterated on the earnings call was that each of the changes that we are trying to do, moving into a SaaS, expanding into multi-chronic conditions, transforming the business from B2C into B2B, each of them have its own impact. But I think that if we're going to combine all the impacts together, we will create a kind of exponential impact on our financial profile and potentially to the growth. So, you know, I get that investors were looking into 2019 numbers and 2020, and they've seen like flat because of the transformation, because we build all the infrastructure. But that's something that is not linear. And I think that moving forward, they're going to start to see gradually how we're going to go in a much more intensive way. That's our objective.
Thank you. Richard, what else you got?
And last one from my side, I just was wondering if you could, like tell us a little bit about your own background and sort of what motivated you to, take the helm as CEO of Dario, and what are your ambitions for the company for the next 10 years?
Yeah, so this is okay. This is kind of a bit personal thing. I mean, I was part of the telecommunication industry for years. I was part of a company called MDocs, DOX on NASDAQ. I was one of the, at the very beginning of this company, and we were going into multi-product kind of solution. We integrated and we made a few acquisitions, and I've learned what does it mean to build the best software, the best solution. And in my background, I'm having a financial background and also technology background. I was in the Israeli Air Force. I was a software programmer, so I did a lot. And then I was in, I had my own startup on e-commerce. I sold my portion, and I joined this one like 8 years ago, 5 months after my father passed away. He was type 2 diabetic. And this is where I started to look into this overall chronic condition management, how to be care. I was supporting my father for many years, and I found two guys that founded this company, and I made a decision to join. I was not the CEO in the first 6 months, and then I became the CEO of the company. And the original idea was, let's build a medical device that can integrate with the smartphone. And I said, the medical device is not the problem. The problem is how you're going to create a behavioral change, how you're going to get someone to support the user. Because I remember that when I was flying and I didn't have connection and so on, the first thing that I would do is when I'm landing is calling my father. And it seems to me like it doesn't make sense that doctor will support 24/7. We need system to do that. And as a software guy, I said, it's a no-brainer. We need to build something like that. That was the vision, and this is how I joined. And over time, I understood that eventually you cannot, the old healthcare industry is referring to diseases in silos. You have a company that is specializing in diabetes, then hypertension, then it's MSK or whatever. And I understood that eventually we need to integrate together. And that's my MDocs background, that was trying to solve a problem from a 360 degrees kind of way. And this is how I build things over time. And I think that one of the big breakthrough when we managed to, get the company to the next stage, make the transformation from B2C to B2B, align the interest with Rick and the team that he brought with him. And I think that today we are very proud that we have one of the best solutions in the market, and also the best team members. And I couldn't ask for more.
Great. Thanks for sharing.
Yeah,
that's pretty much all I have. You guys haven't given guidance yet for 2021, have you?
Yes. So you're right. We didn't provide any guidance. And this is kind of philosophical questions. And I've seen some investors that are criticizing us for the fact that we are not providing guidance. I've seen big companies that are not providing guidance.
I'll say at least half of the companies that reported that I watched didn't provide guidance for this year. Mostly because of the pandemic, right? I mean, the pandemic's created another level of risk or uncertainty. So
yeah. So at that point, I think that I can give you an example. You sign on a health plan tomorrow morning, or you sign in 2 months from now, it might change the numbers of Q3 by millions of dollars. So I'm very confident that we're going to show a significant growth, but the variability might be very high, and for good, because we are working on all the channels and everything is good. We do feel comfortable with a lot of what the analysts are saying, and we have people that are coming from Aegis and from Craig Hallum that are covering us. Sometimes we feel that some of it is a bit conservative, but our objective is to try and beat it. And that's the mindset of the company, very aggressive in our approach in terms of generating sales. The fact that we are not providing guidance, Jonah, is not because we are not confident in our ability to be successful. We just want to be very, very precise and very consistent. And those that are listening to our earning calls for the last couple of years knows that we are very, very consistent with the messages and our promises for what we're going to deliver.
Right. I mean, if a company has a lot of deals in the pipeline, I would rather not get any guidance because I don't want them to be overly conservative. I would rather wait until they see where that pipeline is going. I mean, just so people know, the analyst estimates that I'm looking at right now, 4 analysts on Yahoo Finance have the 2021 revenue numbers anywhere from 21.8 million to 25.5 million, which, I mean, all of those estimates are significantly higher than what you did last year. So, I mean,
yeah, so I think I would say
3x.
that the 21 is super conservative. I mean,
Right.
it's super conservative. I mean, it's something, you know, and we were talking on the earning call, and I'm going to repeat one of the messages. We said that in terms of the pro forma revenue for Upright and Dario, and also the revenue, we're going to grow by at least 2-digit in terms of percentage. So it doesn't mean that we're going to grow from 2.1 to 2.3, because in the 2.1, you don't have the Upright revenue. If you're going to add on that the Upright revenue, which is another few millions, and then you apply on all that, like, you know, 2-digit percentage growth, you're going to start get numbers that are more significant if you are assuming that the two companies together and each of them as a standalone will grow by more than 10%. This is in fact what we are saying, quarter over quarter sequentially between Q4 to Q1. This is what we said on the earnings call, and I'm not sure that investors understood the magnitude of what I said. So that's something that I want to reiterate here.
Well, and these same four analysts have 2022 numbers as high as at an average of 45 million and as high as 58 million. So I think that's the story that people need to realize, is that the flat revenues the last couple of years were they were flat because you were building the infrastructure, you're going out there and forming the partnerships, getting into B2B, you know, which is a 12 to 18 month sales cycle.
Yes.
And now we start to see the revenues.
Absolutely, and you know that, and you know the market. There are those that identify the opportunity in a very early stage. When I was out there in 2019, raising money in order to hire Rick and the team, because I'm moving to B2B and I'm having the best solution, people, you know, realized that, okay, maybe this guy will be able to hire the people, and so we had some investors that got at $4 per share when we did a pipe. After we hired them, we said, hey, we're going to win. And then we got people that get in at $750 per share. And then we managed to win, and people got in at, you know, 17, 18, and so on. And, you know, and people will wait for another quarter or two. Some of them will wait for another 1 or 2 quarters in order to see that we are really executing in order to take it to the next stage. I'm building a business here, and I know that the healthcare industry will go and be more digital. They will adopt solutions that are more consumer-centric. They will adopt solutions that are integrated. So I know that I'm having the solution that knows how to deal with this market. And it's not about one quarter or another quarter. It's about being very, very consistent. And I'm doing it for 8 years as part of this company. And I'm super consistent together with my team. So, you know, one way or another, and we're going to see, you know, the stock is going to go up, down, whatever. But on the fundamental side, we're going to deliver. That's what I believe in. And eventually everything will be reflected also in the valuation of the company. This is, you know, this is kind of, in some ways, a value investment.
I agree. That's why I wanted to put those next year's numbers, you know, this year and next year's revenue numbers out there. Because if you know, just divide the current market cap or enterprise value by the expected revenues this year and next year, the stock looks really cheap, really cheap. So,
yeah, no comment. This is something that you guys, I mean, that's, I don't want to get, you know, to deal with the SEC.
Yeah, so. No, I hear you. Well, Erez, thank you so much. Richard, did you have any final questions or last thoughts or comments?
Yeah, that was all from my side. I think I like that, you know, like on the earnings call, you mentioned that you have like a $600 million pipeline right now. You expect, you know, like 10 to 20% to close. And you said that you were ahead of your enrollment estimates. I think I'm seeing like 30% right now just within your first month. So yeah, like I think that with like the double-digit sequential growth, that sets you up for a good year.
Yeah, absolutely. That's exactly right. And thank you guys for following our story, and thanks for the support. And I'll be happy to, you know, meet again and provide update. We want to be very communicative with the investors community.
Let's do it every 6 months. We'll come back and do it again.
Okay, sounds good. Thank you, guys.
Thanks, guys. Thank Richard.
Bye-bye.
Thank you. Appreciate it. Bye, guys.